doing it. Okay, we'll start the meeting. Right, good afternoon, everybody. Welcome to all of our guests. You may have just heard me say, because one guest is slightly late arriving, we'll run through all of the other business of the committee, which will be very brief. So please feel free to kick back and relax. You won't be asked any questions at this point. If we get to the end of all of that, and we are still awaiting Mr. Webster, we will adjourn the meeting and reconvene when he gets here. Okay, item 1 is apologies for absence. We've had apologies from Jeanette Arnold. For him, unfortunately, there was no substitute found. We had a late apology, a completely unavoidable apology from Assemblymember Duval. Very helpfully, Assemblymember Shah, at very short notice, has agreed to attend. Otherwise, we would have been in court, and you would have had the afternoon back in your offices rather than here. So it's either a good thing or a bad thing, depending on your point of view. Item 2, declarations of interest. The committee has recommended, Navin, you and I are recommended to note the list of offices held and to declare any further disclosable pecuniary interest.
Chair.
Thank you. Items 3, 4 and 5 relate to the membership, terms of reference and standing delegations of authority for the subcommittee. Do we agree to note those?
Yeah.
Thank you.
Yeah.
Item 6 is the minutes of the previous meeting. Is it agreed that I sign those as a correct record?
Chair.
Thank you. Item 7, summary list of actions. We're recommended to note the outstanding actions arising from a previous meeting of the committee. Is that agreed?
Chair.
Item 8 is the Quarter 4 16-17 GLA monitoring reports. We're recommended to note those reports. Is that agreed?
Yeah.
We'll skip over item 9. Item 10 is the Mayor's decision list from the 9th of March to the 8th of June 2017. Is that agreed?
Chair.
We're also asked to decide whether to refer any issues to the Budget and Performance Committee for detailed consideration. I don't think there's anything that we want to do, so we won't do that. Item 11, payments over £250. Can we note the report detailing those payments?
Chair.
Thank you. We will come back to item 12, which is any other urgent business, and item 13, the date of the next meeting, a bit later on. We will now go back to item 9. Mr. Webster is here. Welcome.
Apologies for lateness.
Quite all right. I do understand what the lifts in this building are like.
That was exactly where I was stuck.
Indeed. I've often thought a fire pole might be good, and maybe Sue Budden could take that back to Union Street and discuss it. Okay, the main item of business today is to look at GLA Group borrowing. I'd like to welcome our guests here today, Luke Webster, Group Treasury and then Chief Investment Officer of the GLA. Emanuela, forgive me if I get your surname wrong.
Cernoia-Russo.
That's exactly what I was going to say. Thank you very much. Assistant Treasurer at Transport for London. Simon Kilonback, Director of Group Treasury at Transport for London. Sue Budden, Director of Finance and Contractual Services. Has your title changed, Sue, since I was not Chairman? I should have noticed. I always thought you were just Director of Finance. At the London Fire Brigade, and Ross Campbell from the... I beg your pardon, Martin Wheatcroft from the...
Yes. Well, I'm representing the Institute of Chartered Accountants. I actually don't work for them, but I am a member and I work with them.
Thank you very much indeed. And thank you, because you're a late replacement, aren't you, for Ross Campbell?
So, yes, unfortunately he's fractured a bone in his foot and can't get around very easily. So
that's very bad luck for him, and potentially for you. But thank you very much indeed for filling in. It's very decent of you to give us your time. Okay, so I mean, what we'll start off with is a bit of scene setting around risks and borrowing, and when we borrow and why we borrow. So Martin, I'm actually going to start with you. And if you could outline the circumstances where it might be appropriate for a public sector organisation to take out long-term borrowings.
Sorry, I'll just bring out my notes. So yes, there's quite a few circumstances. I mean, there's a wide range of reasons that you might consider borrowing to finance expenditure. It's actually wider than would be appropriate in business. Generally, any financial expenditure that provides a financial payback, which provides a commercial return, financial return would make sense, provided it's within the remit of the particular local authority or other public body. But generally, you have a wider purpose, so spending that improves economic activity, that generates tax revenues either for you or for the wider public purse, spending that reduces risk, that you might, for example, a current topic is fitting sprinklers and things. But also wider, you don't necessarily need to have a financial payback. If there is a clear public benefit, you can choose to borrow. But that would be mostly appropriate where the benefit is longer term. So, for example, if you were to decide to invest in building a new park that is going to benefit Londoners over a long period, it might be appropriate to borrow. Obviously, generally, borrowing to create an asset is better than if it's just an expense that is gone. But again, it sort of comes back to what the purpose is, and understanding very clearly what you're doing. Are you doing it for financial return, or are you doing it for public benefit, or a mixture of both? So that's probably the key things. Yeah.
Is it appropriate to borrow for to fund operating expenditure?
It can be appropriate, but is generally not a great idea in the longer term. Of course, the national government does this all the time and has done this significantly, and that creates an intergenerational limit. But generally, most authorities have borrowing limits, which means that you're in less of an issue around intergenerational fairness and things like that.
That was the golden rule before 2008. Not following that, is that a bad practice? What the risks are?
I think borrowing generally, if it's done for the right reasons, is actually a very good thing. If you buy a house with a mortgage, generally you're getting the benefit now. Otherwise, you might have to wait 30 years to save up to afford one. So there's definitely a real advantage. And also, if you're as a public authority you can borrow at very cheap rates. There are opportunities there. I think if you're asking about the national government's position, I mean clearly it's got substantial debt and substantial other liabilities.
The concern being, for example, for GLA functional bodies, incurring debts by sort of, and that obviously puts pressure on revenue.
Yes, it does. I mean the key thing with debt is that it becomes your priority. The first thing you have to do when you open the checkbook at the beginning of the financial year is pay off your debts, any repayments and any interest. So by choosing to borrow, you're making that your highest priority item. And therefore, if there's any pressure, this probably goes into some of the later questions, but if there's any pressure, then or income shortfall or whatever the issue is, it's other services and other priorities that suffer because you are committed to the borrowing and servicing that borrowing.
Indeed, Chairman. I just wanted to clarify for members of the committee and the benefit of the audience that the GLA and its functional bodies are all local authorities and subject to the various local government acts, part of which include the requirement to set a balanced budget. Now, borrowing proceeds, of course, are not a revenue resource, so it's legally impossible for my colleagues or myself to incur borrowing to fund revenue activities. So it's purely a capital transaction in local government space.
Okay, I think that's an important clarification. What are the risks, Martin, or the general risk and benefits to public sector organisations in taking out long-term borrowing?
Well, the benefits are very clear. You can do things now that you couldn't do if you saved up. You can afford much larger forms of expenditure, and building something like Crossrail or Northern Line extension are clear examples of it would take a long time to put money aside. It's much easier to borrow it now, do it, and then pay it back out of the increased revenues and so on. And of course, the other key advantage is that as a public body, you can borrow at very low rates compared with private sector. So again, if a private sector organisation was to choose to build Crossrail, for example, it would have to borrow. The economics would be very different because the borrowing costs would be that much higher.
So, interesting question.
So sorry, that's benefits. And on the risk side, but the risk side, it is you are tied in for the long term, and therefore you create a more leveraged organisation where cash flow management becomes even more important. So every time you commit expenditure, and this is the most committed form of expenditure, you reduce your ability to manoeuvre, and you increase the risk that if there's something goes wrong, or there's an income shortfall, or whether that's tax revenue or fares revenue in the case of TfL, obviously you have less room for manoeuvre than if you hadn't borrowed.
Luke has just pointed out that all of the functional bodies at the GLA are local authorities and subject to local authority regulation in terms of borrowing. Does that include what you use the money for? You can't use it for revenue, but if you can borrow cheaply, could you potentially lend it to somebody else for more?
That is legally possible. Yeah, the restriction is for any purpose relevant to the authority's functions, and it being a prudent means of managing one's financial affairs. But yes, that's certainly possible.
So
in substance, that's what we do with some housing activity. We borrow from central government to facilitate lending within the housing zones, for instance.
if the objective of lending the money back out to someone else was to create an income stream to supplement activity, to plug gaps in revenue, for example, could you do that?
We could, in that it's legally possible. Our flexibility to do anything more speculative like that is severely limited at the moment, but it's a theoretical possibility.
Yeah. So you wouldn't be allowed to get it to borrow money and then go and put it on the 230 at Chepstow?
It would have to be a very creative interpretation of prudent management of one's financial affairs.
Absolutely.
There is another exception, which is to the extent you have funded pension schemes, you in effect do that, but that's for the primary purpose of providing money for those pensioners.
And that can be funded by borrowing?
In effect, yes.
Okay.
But within that ring fence, the pension fund. It has, and there are limitations.
Turning to our functional body representatives then, and this same question to all three of you, is what are the risks and benefits most relevant to your particular organisation? So we start at this end of the table, so start with you, Sue.
Okay, our capital programme is about replacing and refurbishing operational assets, so it's mainly about the fleet.
Yeah.
Those of you remember we used to have a PFI, but now we own our own fleet, so we're responsible for its replacement. And it's about our fire stations. We've got 102 land stations in various states of repair, so some of them are very old, some of them were all built at a similar time, so hit similar redevelopment and refurbishment requirements at the same time. So borrowing allows us to meet the cost of doing that kind of activity over the life of the asset it creates. So linking back to the points that Martin was making, we're not saving up to invest in a new pump, we're spending the money now so we can replace the pump as we need it, and then we'll pay for the cost of that over the life of the pump. And we do benefit from reasonably low interest rates, and we also, certainly all the time I've been there, it's always been most prudent to go for fixed rate loans, so we've also got price certainty, so at the time we've taken out the borrowing, we know exactly what it's going to cost us until the debt is paid off. So the only real risks we've got are about the interest rate at the time of taking out a future loan. So if we said we wanted to replace, buy a new fire station or replace a certain bit of kit, and we had to do it at a certain point, we'd be at the risk of whatever the interest rate was in the market at that point. We can try and mitigate that through greater work through the group investment syndicate, looking across the group at how we borrow. And the other risk would be around our future funding. So I don't think our debt costs are significant in relation to our total grant funding from the Mayor, but if that funding was to come down, then that would obviously be somewhere we'd need to look about affordability, which also links back into Martin's point. We've got 4-year plans now under the new regime at City Hall, and that helps. So we're looking all the way forward to 21-22, so we can see how our borrowing costs play out as part of that. So that helps us have more certainty with our internal planning, and it makes that internal planning more real because we can then debate it in public. So.
We're going to have a slightly deeper dive a bit later on in the meeting into each of the functional bodies in turn, so some of that stuff I think we'll pick up a bit later on. Simon, from Transport for London's perspective.
Yeah, absolutely. So in a similar way, we only borrow to finance capital investment in TfL's assets. And unlike other local authorities, we should say that, as you know, local authorities have the power to set their own authorised limit for borrowing, but that's subject to the power of the Secretary of State, the relevant Secretary of State, whether that's transport or communities and local government, to have a reserve power to cap that borrowing if it's not in the national interest to exceed the borrowing. So because of the nature of TfL's investment programme, in addition to the authorised limit approved by the Mayor, TfL also has a funding agreement with the Department for Transport which sets out limits on our borrowing and a profile of borrowing over a number of years. linked to the delivery of certain infrastructure projects which are agreed to be shared national priorities. So our borrowing is very much dedicated to specific infrastructure assets that we've agreed with national government are shared priorities for the country as a whole. And then in terms of the benefits of doing so, having if you recall, when TfL was set up, the majority of London Underground was privatised, and the majority of the investment in its assets were expected to take place through PFIs and PPP arrangements. And what we found since Metronet collapsed into administration and Tube Lines was bought back in order to deliver better value for money, is that to the extent that we can borrow on our own balance sheet, it gives us more operational flexibility with the assets that we're acquiring compared to entering into long-term PFI arrangements with the private sector or a third party.
Okay. Luke?
From the GLA's perspective, the primary benefit is being able to unlock strategic infrastructure and regeneration projects across the capital. So that ability enables us to make projects like Crossrail, Northern Line extension, acquisition of the Olympic Park actually happen. And it would be impossible on the sort of save up in advance model that Martin alluded to. So that definitely is the benefit. The risk is pretty considerable, I think, of all of the functional bodies, and indeed most public entities in the world. Our level of borrowing is very, very high. The GLA budget document, which you'll be very familiar with, is perhaps not the most straightforward document to understand, but if you sort of narrow down on the core GLA spending, so excluding grants and other payments made around the group, of the GLA's own spending, almost 50% is actually on debt service. So our financial flexibility is very constrained by the levels of borrowing that we currently hold, and obviously that's a key decision when we're looking at further proposals for borrowing. So managing that risk and that risk of lost flexibility is the primary focus of my team.
Martin, what are the key warning signs to look out for to indicate an organisation is borrowing too much?
Well, primarily if things start going the wrong way. So if your asset base is growing less fast than you're borrowing, or how, if you look at it the other way around, interest starts to become too high a proportion than you want. So as you say, if you're already at half, if you start going to 2/3, then you're probably really in trouble. So you have to keep tight of that. I mean, in the commercial sector, lenders generally impose requirements called covenants on borrowers to in effect manage that sort of risk. Now, generally for public sector borrowings, you don't have that, because generally public sector borrowers are considered very good for the money because of the ability to pay out of future tax revenue and the implied guarantee from central government. But I don't know to the extent that you have your own internal metrics, because that would be probably the best way you would know is to, based on your own risk profile, to actually devise your thing. There's no specific number or ratio that works. It has to be specific to the organisation and the circumstances and the risks related to its revenue streams and to its cost streams.
Okay, Luke, then throw that one back to you. How would you know if the GLA was borrowing too much?
There are indeed a number of metrics that we use. We're subject to a credit rating process from Standard & Poor's, and there are a number of metrics there that compute the level of debt costs in relation to various income streams, and we try to maintain within the parameters that are consistent with our AA rating. We also are subject to local government regulation through the Chartered Institute of Public Finance and Accountancy, so the relevant document is CIPFA's Prudential Code, which again prescribes a series of indicators that we use internally for management purposes. But really the nuts and bolts of what we do is matching the cash flows of debt repayment and interest to the income streams that we have. And that's really how we're able to maintain a very, very high rating despite this huge level of what in the private sector would look like gearing. Of course, in the public sector there's a different concept. In a business you typically borrow to grow in pursuit of more revenues. In our case, we're granted the right or ability to raise revenues to facilitate the borrowing, to then facilitate the strategic projects. So it's kind of different way of thinking, but the risk management is exactly the same, very closely making sure that our revenue streams correspond very closely to the debt service. So in Sue's example, the way our FIPA's funding model works, similarly for the police, there's a lot of sort of fixed lines in there. So we typically look for fixed rate borrowing to achieve budgetary certainty of cost. There are some examples where that's not the case. So for the Northern Line extension, for instance, that's an example of tax increment financing. So the income stream there is business rates, which, as you'd be aware, has an inflation linkage. So in that case, some of the borrowing that we've done is linked to the same inflation measure. So it's all about very, very close asset and liability matching.
So your debt management strategy, could you outline it? The key principles of your debt management strategy for the GLA Group?
Yeah, I'll defer to colleagues at TfL to give some perspective on their approach, but as you know, the GLA looks after...
What we're going to do now is go through the functional bodies. So starting with the GLA, the core GLA, so you. We're going to ask TfL more or less exactly the same set of questions in a moment, but...
Sure. So for the GLA, and of course we do provide a shared service to the most of the rest of the group, so we're pretty cognizant of the debt approach there. But we are looking to first of all make sure that the profile of the debt, i.e. the way it matures, corresponds very closely to the life of the relevant assets. So we're not setting ourselves up for a position where we'll have to refinance our borrowing midway through the life of the asset, and that takes a level of interest rate risk out of the picture. As I said, that very, very strong emphasis on matching inflows and outflows to avoid the likelihood of having to use reserves or temporary borrowing to bridge gaps is an important part of it. And constant analysis of market risks and opportunities to look for ways to achieve savings or reduce risk.
Now, we've moved on to the borrowing that we're taking out at the moment is now being measured against the Consumer Price Index, isn't it?
Some of the borrowing that we've done for the Northern Line extension is linked to the CPI.
And why was that decision? And I gather that that's going to save £61 million or something over the lifetime of the debt, which sounds good. If it is, why haven't we done that elsewhere?
Well, I think, again, we haven't necessarily had revenue streams that are so explicitly linked to inflation before. So really, the cost saving is very nice. I think that sort of 60 million figure is the combined saving that we've achieved across the NLE borrowing piece. The bit attributable to the index-linked bond is probably about 34, but very significant. But in a sense, that's a nice to have. The primary objective of the exercise was to reduce risk. So we had a business case for extending the Northern Line, which assumed a certain level of inflation and therefore a certain level of income. Now, had inflation been lower, that income would be reduced, and we could then find ourselves in the position of struggling to pay our interest costs. So the beauty of taking out debt that's linked to the revenue stream is that if inflation falls, yes, the business rates fall, but so do the interest payments we have to make, and ultimately the principal repayment at the end. So it was a hedging decision in the first instance, and it happened to save a very considerable amount of money too.
Do you see that being the model for other areas of borrowing across the group?
I think it requires some caution. I think it's entirely natural for public entities to focus on fixed rate exposures, so that budgetary certainty is achieved. I think that clearly there is a shift in local government funding towards business rates, but I think I would be quite cautious about recommending index-linked borrowing as a new normal. In the case of the NLE, we have a clearly defined enterprise zone there, an agreement with HM Treasury to essentially give us indefinite refinancing. So there's a range of additional levels of certainty which were supportive to the overall decision.
Okay.
Yeah, Chairman, if I could add a couple of points here. The main benefit of linking to CPI is, in effect, you are protecting against lower inflation than expected, and that's a reason a lot of our national debt is RPI linked. It is a hedge against low inflation. At the moment, we are in a situation of low inflation, so your risk probably is on the other side. As you say, as long as you've got that income stream that's linked to inflation, then you're okay. What you've in effect done is you've exchanged a certain sort of benefit, that's presumably what the 34 million is, in exchange for, if inflation goes up, you have to give some of that benefit to the lenders. So that's what you've done in terms of the hedging. Some of the upside in terms of higher inflation would go to the lenders. So that's whereas if you've got fixed borrowing and inflation goes up, then you get all the additional revenue from the higher inflation.
Okay, I get that. Now, Luke, you said earlier on that approaching 50%, I think, by the end of this financial year, of the GLA's revenue is spent on debt servicing. How much debt is too much debt?
Well, I think it's a question of sustainability, and that depends on the nature of the income streams that stand behind the debt. So, in the case of the bulk of the GLA's own debt service is related to the first Crossrail project, and that's underpinned by an enormously secure tax. The business rate supplement is a fantastic revenue perspective for a treasurer to have. It can be levied indefinitely. It's very stable. Our statistics have been very favourable to date in terms of collection. So with a revenue stream like that, the level of debt service that it's supporting relative to other activities is a little academic. In fact, when you've got such certainty of income, you tolerate a very high level of borrowing.
So could you push that to 70%?
If we were to have the corresponding additional increase in tax raising powers for a similar type of tax, then yes, theoretically that would be fine. I think the issue is that looking forward, a lot of the income streams that are likely to become available to support additional borrowing will be much less certain than the BRS itself, and so at that point other considerations have to be brought to bear, and where there's a sort of funnel of uncertainty around the difference between income and expenditure, clearly for an organisation like the GLA, which is very small in terms of its core expenditure, that's a severe risk and would need to be considered very, very carefully. Okay. There's not a precise number. It depends on the income streams that you're getting to support the debt.
And presumably that's why the GLA employs people like you. Well, make sure that we don't make that mistake. Okay. We're going to turn to TfL now.
Yeah. Well, I spent all morning discussing TfL's very ambitious strategy for transport provision. Which is obviously very ambitious, and to deliver that we have a very ambitious business plan as well. Yeah. Now TfL is the borrowing is going to be it is the highest, the most from all of our GLA bodies. Given that situation, the starting question is, what do you plan to use your long-term borrowings for over the next 4 years?
So over the next 4 years, the project that we're going to finance is set out in Annex B of our funding letter from central government. So these are the projects such as completing the upgrade of the subsurface lines and rebuilding and enhancing the capacity in Victoria Station, Bank Station, ensuring we have 36 trains per hour on the Victoria line, doing the structures and tunnels investment programme. So following the Hammersmith flyover, we've undertaken a piece of work to look at the state of good repair of all of our major road tunnels and structures, and are investing money in the road network as well as the underground network. And as I said, it's all set out in Annex B of the funding letter.
We've got Mayor's Capital Investment Plan, which shows TfL taking some 122 million of capital funding to spend on revenue for 2017 and 18. Does this mean that TfL borrowings could be used for revenue expenditure?
No, so you have to be very clear that the TfL only borrows for capital expenditure, as we've said. We receive different sources of funding from the GLA and currently, although not for much longer sadly, from the Department for Transport in terms of a dedicated transport grant. And we therefore use first our own source of revenues, then business rates. Now in the financial tables, much improved financial tables, I hope you'll agree, in TfL's business plans and budgets, we try to make as clear as possible the fundamental financial performance of each part of the business. But we've included depreciation and amortization and financing costs in the operating account. Whereas, as Martin said, in reality, financing costs come out first. So in the table, they come in last, but in reality, they come out first. So we're not using capital funding to finance.
How's your borrowing limit set with central government? Can you explain a bit more detail?
So because central government grant and borrowing both form part of public sector net debt, what we do is agree, first of all, the projects that need funding, and then we look at the ability of TfL and the GLA to contribute to that funding, and then the government's appetite to contribute to that funding. And then what we do, because effectively on the national balance sheet, grant and borrowing have the same effect, is work out what the affordable and sustainable level of debt for TfL is, and agree to take that as borrowing, with the rest coming in grant form from the Department for Transport.
And how does the annual central government borrowing limit work with Mayor's borrowing?
So effectively, we every few years have engaged in a tripartite discussion with the Department for Transport and the GLA and ourselves, and that forms the basis of the funding letter, which sets out the profile of borrowing and the amount of debt that we can afford to undertake. Effectively, those borrowing limits match to the operational boundaries in our prudential indicators. And you can follow that through, because you can see the incremental amount of debt increases in line with that in terms of the forward-looking prudential indicators. And then we allow a headroom for refinancing of either maturing PFI transactions or debt maturities, in order to set an authorised limit that has about £1 billion of headroom over and above our expected level of borrowing. And that's how the authorised limit is set in relation to the government borrowing limits.
Given the ambitions you have, if the borrowing limits from government were to be raised, would you choose to borrow more? Do you think you may need to?
We would only choose to borrow more to the extent to which we could satisfy ourselves that it was affordable. So, as Luke said, we are, as you know, seeking to put TfL onto a firmer, a more sustainable financial footing. So over the last 17 years, it's been the government's appetite to increase its own balance sheet that's been the constraint on TfL's borrowing. But we've gone from a place where London, the GLA and TfL had zero debt in 2000 to a place where we have a significant amount of debt in 2017. So we are only looking to add to that stock of debt at the rate at which we can afford to service it. So either from other forms of direct taxation, from retained business rates or other forms of devolved funding, or from increases in demand for our services generating increased revenues. So we will increase at that pace.
Okay. TfL is facing some significant financial challenges over next 4 years. If your borrowings were to be affected and if you fell short on your ambitious saving targets, or if your revenue from fair forecasts were to fall, what happens?
Well, we would have to consider in the context of having the legal requirement for a balanced budget and setting a business plan, whether it's still prudent to borrow the amount of money that we currently project that we'll be borrowing over the next 4 or 5 years.
I think
And-
that was the question. Sorry.
Carry on.
The borrowing, let's say for example you borrowed over a period of time and fares income goes as it should for some of that time and then goes down for whatever reason. Do you then have to make adjustments to your revenue spending accordingly? Because as we said, heard from all of you, debt servicing is the first priority all the time. So presumably that would constrain your ability to deliver revenue projects elsewhere, wouldn't it? So you might have to take, for example, worst case scenario, you have to start laying people off because that's your biggest revenue cost, isn't it? Is that fair?
No, actually, people aren't our biggest revenue.
They're not?
No.
Okay, that's interesting. Who are your biggest revenue costs?
So if you actually look at in our financial accounts, the bus contracts collectively are our single biggest revenue costs, and then the cost of the operating costs of running the rest of the services, and with so we have effectively £6 billion paid to our supply chain in the context of the operating and capital investment programme. There's about £2 billion paid to the bus companies every year to run the bus network, and then about 1.7 to 1.8 billion pounds in terms of TfL's own staff costs.
How much freedom would you have to take revenue from your contracts, say your bus contract, for example?
As part of our transformation programme now, we are looking across every area of our spend. So not just the bus contracts, but every contract we have, whether it's cleaning and facilities maintenance, right the way through to the larger contracts, to look at how we can deliver the level of services we need to deliver more effectively in terms of the cost, and also the capital programme in terms of the specification and what it is, how can we buy it in a smarter way. And we are sort of a year into the start of that journey.
Okay, so to take the example that we've just given, you've borrowed money for whatever reason, fares income is dropping, let's say sharply, for whatever reason, so you've got to make some adjustments to your revenue outgoings in order to service the debt that you already have. What would be your first port of call?
So if we just say, first of all, we, as you would expect, on a regular basis, look at all of the options we've got through either other sources of income. So we would look at those as well as making cost reductions or making reductions across the capital programs as well. And we would look at which, across that £10 billion of annual spend, where we could actually save that money very quickly.
Yeah. Okay.
Chairman, if I might add, I think just to hopefully help Simon out, apologies if I don't, I think what you're indicating is that because you're intending to borrow more, the first thing you would do is slow down and defer some of your projects so that you would stop increasing your borrowing as fast as you originally planned it, and that would be the obvious first thing to do if you have a slowdown or a reduction in revenue. Then you would look at your options for either cost saving or fare increases to the extent you could, or whatever, to try and make up the shortfall.
So
or whatever.
which
But
makes
you
sense.
would defer first.
Yes, but
and
only
you would then cut discretionary, and then you would look
But
at
if you were to
other
defer,
things that were non-discretionary.
if you were to defer, reduce borrowing,
That would put.
how would
back
you
some-
choose?
That's
No.
a question for Simon.
yeah, sorry.
It's probably a question for the mayor, isn't it? Eventually, ultimately.
Well, ultimately, you're right.
How would you prioritise?
It's a question ultimately for the mayor and the TfL board in terms of the annual prioritisation
But that would be based on your advice, presumably.
on the advice of TfL executive committee.
Yeah, don't worry, I'm not trying to set you up for something. No.
Yeah, well, if we can move on to the next question. How have you how confident you are that you have sufficient headroom between your planned borrowings, your borrowing limit, should things go wrong?
So,
Same.
so as I said,
Yeah.
when we undertake our business plans and forecasts,
Mhm.
we look at sensitivity analysis of what may happen, and we set a level of borrowing that we believe is affordable,
Yeah.
given that there is likely to be
Mm.
some variation in income and costs over time. As Luke mentioned earlier on, the different functional bodies will have different risk appetites. Because TfL is a very large and complex organisation with a very high level of operating costs and costs that take time to manage down, our appetite for our ability to raise £1 of borrowing for every £1 of income doesn't work in the same way as for the GLA themselves, who, if you have a dedicated stream of taxation, then you can look to borrow the majority of that income stream because you can hypothecate it to servicing the debt. For us, we have to take into account the deliverability of the plan and then set a level of borrowing that we feel we can do, even given some scenarios about what might happen around the deliverability of that plan.
I think this is, I don't know whether it's Luke or Martin. Is it normal for organizations to take out borrowings right at the top of their borrowing limits from central government?
There is no normal in this. I
Really?
think it's up to the individual circumstances on this. I think the main thing is that is not to use the limit as a target of we can borrow up to the limit. Now, what do we do with the money? It has to be that you have genuine projects of public purpose that are worthwhile investing in.
So,
Or that produce financial return, and that has to be the priority. So it's not uncommon to see a lot of people up near their borrowing limits, but the question is why they're there.
So in the case of TfL, as we've said, we've agreed the projects that we're going to finance with central government. So the limit is set to allow
That
those
comes
projects
to
to be
yeah.
financed.
I think it probably is worth clarifying that for the rest of the group, in general, the limits are limits we set ourselves, and they represent the maximum level of sustainable finance in our regard. So yeah, there is that self-determination. It's by no means a target to get up there. We're saying we can't go beyond this point, and clearly we're trying to save public money to the maximum extent and then stay below that where we can.
Back to Simon, it looks from your business plan that you are taking out new borrowings, substantial borrowings, but at the same time you're not planning to pay off any of your existing debts over the next 4-year period. Can you explain how is this the situation?
Well, it's normal in a large corporate that is investing significant amounts of money in enhancing its assets in order to grow its business and generate future revenue receipts. So first of all, we match the repayment of the borrowing to the economic life of the asset, and a number of our loans do in fact amortise over time alongside the profile of those assets. It's hard therefore from the accounts to see that is indeed happening, because we are taking out new borrowings to finance more assets at the same time as loans that have been taken out previously are indeed amortising off. And it would not, given we have a set amount of money that we can invest in capital expenditure to use it to pay off debt at the same time as we are trying to invest in upgrading and renewing the main transport infrastructure assets and adding to those transport infrastructure assets, would not be a good use of that capital headroom.
Yeah, I understand that, but is it sustainable? Is it fair that by not paying your debts, you're actually sort of increasing the level of debts to the next generation?
Well, as I said, we are actually repaying some of the debts. So the debts are amortising in line with the profile of the assets, for example, rolling stock that we're financing. So It's not correct to say that we're not paying back the debts. We are paying back the debts that we raised, but we are raising new borrowings to invest in new assets, which future generations will benefit from.
This year we are paying, for example, we're paying back over 300 million of existing debt and raising additional debt to fund the Crossrail rolling stock and depot and additional Crossrail infrastructure.
I think it's this is quite an important point for external observers understanding public sector balance sheets. What we do very rigorously is keep track of each asset and its useful economic life over time. So within our accounts, you can compute a quantity of essentially capital expenditure that's occurred but has not yet been funded, but either by being charged to revenue or by some other source. We call that our capital financing requirement. And we'll break that down in the GLA's case into the Crossrail, NLE, Olympic Park, and very carefully make sure that those are being amortised, so the charge is going through revenue and we are paying for that. But there's a difference between that accounting discipline and the management of the borrowing portfolio, which we do by looking at the overall cash flow position and doing it on an aggregated basis. That's a fundamental principle of the Prudential Code. So you may not see individual loans being repaid at a specific time, but the accounting entries are going through, and the debt will reduce over time in line with the useful life of the assets. But if the total asset value is growing, you'll just see an increase in debt.
Well, that's helpful. Thank you. Over to you, Chair.
Thank you very much, Darren. Sue, your side. FIPA has been in a relatively, from a financial point of view anyway, happy situation of having large capital receipts to use to finance the capital programme in recent years. That's due to end in the next financial year, I believe, isn't it?
Yes. Well, we've still got to sell 8 Albert Embankment, and we haven't factored in any receipt.
For Albert Embankment?
That's
Oh, okay. Because that capital receipt would be considerable.
yeah, but then, I mean, you know the history around trying to sell that site, and until we have a successful planning application, I'm not prepared to factor in any receipt from that into our current projection.
Which is prudent, obviously. But that said, as and when that happens, then any further borrowing for FIPA for some time may not need to take place. Is that correct?
So well, I wouldn't say we need to borrow at all, but it would certainly give us an opportunity to look across the piece. It would make a material difference to the forecast that you've had in front of you, which show us moving purely to external borrowing to fund the capital programme through to 2021. It would make a significant difference to that.
Yes, it would. And it would also, I mean, should that happen, then your debt financing costs would almost, well, they wouldn't be negligible. They would be minimised considerably, wouldn't they? Which would presumably free up revenue for other things.
Potentially. So we've been reducing debt over time. So since 2011-12, our debt's gone down by about 30 million. And obviously our financing charge has gone down as a result of that, so it's now about 9.5 million a year. If we weren't to borrow at all from next March, over the lifetime of this plan, we'd save about another 4.5 million. So we'd sort of half our debt charge. I don't know that we could get into that position.
I was going to say, how realistic is that? Because clearly the fleet's being replaced. We know about that. We know about the need to try and, if at all possible, speed that up because of ultra emission zone and things. The other thing, without going into areas that might get swallowed by public inquiry, that there have been or has been speculation in the media about the need to buy certain types of new appliance for certain types of incident. Is that being factored into your capital investment programme?
That's what we're looking at now, because we revisit the capital plan every year as part of the budget setting process, and there's a streams within that for various fleet replacement, including air appliances. So that's what we're looking at.
I was trying to be discreet and you've just gone. Thank you very much. I won't bother next time. So we could get to the stage, presuming Albert Embankment, let's assume it doesn't go forward. I know what a sore that's been for a decade more. Would we be in a situation where the London Fire Brigade is servicing its entire capital programme through borrowing?
For the new programme, yes. So we still have assets that were live that had been funded through receipts, but our new spend would be funded through external borrowing. Yes.
Okay. Martin, is that common, normal?
It's not unreasonable. The key issue with any decision to borrow, and of course, if you lease an asset, you're borrowing the whole amount. If you choose to borrow to that, is really what the risks are relating to that, and whether you've got sufficient cushion and resources. So normally, lenders don't like to lend the entire capital programme for, say, a private business, because it creates too highly leveraged a business and too risky a business. But in the public sector, because you've got the resource of ability to tap into taxpayer revenues and so on, that's much more comfortable. And it does depend. I mean, the Fire Authority is part of a wider network with the GLA, so you've got a wider pool to so if one particular unit is borrowing, it's not such an issue.
Yeah. Would that require mayoral intervention on that? So I'm taking from what you just said, let's say, for example, the Fire Brigade is borrowing massively. I mean, compared to the wider GLA group, the Fire Brigade is a small part of the wider group. But if it's borrowing massively and your budget is strained in terms of servicing that debt, that would require mayoral intervention to move money around the group, wouldn't it? It's not something that would happen automatically.
That's true. If there were a sort of aggregate decision to reallocate resources, that would clearly be have to be taken at a mayoral level. But I suppose one of the things that we can do as a result of our very close shared working now on finance issues generally, but particularly Treasury, is we can look to potentially reallocate debt around the group. So if Alfipa had, for instance, a new flexibility to not require quite so much borrowing, let's say the Albert Embankment receipt emerges next year, it may be possible to, rather than Alfipa being stuck with its existing portfolio and having to cover the interest charges on that, if the GLA has a borrowing requirement at that time, we may be able to move the obligation over. So there are flexibilities to manage things at a group level.
Okay. That makes sense. I think that's music to the ears of everyone. With regard to Alfipa's capital programme, assuming Albert Embankment doesn't go forward, there would need to be more borrowing than there is at the moment. What impact is that going to have on revenue? What I'm getting at is your ability to service any potential future debt.
So the additional borrowing from the capital programme we presented in March is around 3.3 million. The cost of that that's where we'll be up to by the time we get to 2021.
Mm-hmm.
So it'll take our borrowing as a percentage of our total funding from, I think it's about 2.5% now, it'll take it to a little over 3%. So it's not significant in percentage terms. We don't borrow until we are spending. So we have options to look at the size of the capital programme as we go forward. So if we found it was difficult to meet whatever our funding was as set by the mayor, or it changed in some way, then we could look at the capital programme, we can take decisions. So we have in the past said, as part of the savings round, shall we stop investing in the estate for a period of time in order to save some revenue money? That always feels like a very short-term attitude to take, because it continues to deteriorate whilst you don't invest in it, and it becomes more expensive in the end. But they are options. So we haven't got a capital programme that's all live now. They are aspirations to spend in each year, so there are choices that we can make. One of the other things that constrains us as well is also our ability to spend. So we're quite a small organisation, and we have aspirations around improving the estate that can be quite slow to achieve. So that constrains the size of the programme in itself, beyond the cost of debt.
Okay. Thank you. Wider issues now.
I have wider issues in the main to do with access to finance, interest rates, and credit rating, which affect everyone around the table. Before we go into that, just a general question to look about GLA's borrowing level. I mean, why has GLA Group borrowing increased quicker than local authority borrowing over the last 5 years? Partially, you probably mentioned that, but if you can go into
yes,
that,
certainly. I mean, to an extent, it's a sort of statistical artifact rather than any sort of particular trend. The fact is that the GLA has gone from 0 to a very high number in a very short space of time, and that's as a result of the opportunity to participate in the Crossrail project fundamentally. Followed by rapid the dissolution of the LDA and the assumption of their debt obligations increased things further, and then the Northern Line extension came along again at a pretty approximate time. So really it's just a function of opportunity to deliver these strategic initiatives.
We have, let's not forget, OPDC, the Old Oak Common MDC to come in as well, for which I don't know whether you have any indicative figures as to level of borrowing that would require. So, overall, the fact is that we are, fine, we are strategic authority, and therefore we have greater demands and a huge budget, but you reckon we still... Yeah. That's
right. I think it's important to view the GLA's role in this area as a sort of aggregator for London. Prior to the GLA's existence, then some of these initiatives would have happened, but the borrowing might have been fragmented between several authorities in different places. One of the advantages of having a strategic authority is that we can do a more sort of global asset and liability matching exercise and hopefully get a more efficient result.
Yeah, that would be good. Martin, is it concern you that the growth in GLA Group borrowing has been more than 8 times the growth of local authority borrowing over the last 5 years?
No, I think I would agree with Luke. I think it comes down to a lot of the fact that you have bigger opportunities in London than many other parts of the country. So you've been given the powers and opportunity, and the projects have been there. Generally London, overall, when you look at it from the overall public sector, it's generating about 30 billion more in tax revenue than the public purse spends in London. And if you spend £1 here, you get a much bigger return, simply because of the benefits of scale of London as it is. So unfortunately, it's probably more a sign of the issues that the rest of the country have in attracting and being encouraged to borrow, to invest. I think you're benefiting rather than it being a concern the other way around.
So it's fair to say that Londoners are getting better value for their money. And,
the economies of scale of a big city are such that, and of course being, as we all know, London's a very prosperous city. So generally, from the overall public sector, generally one of the problems that the country has as a whole is that it makes a lot more sense to invest in London because the return both in tax revenue and in fares and things like that is much higher than it would be in the North of England.
If we can move on to access to financing, this is both to TFL and Luke. Do you expect Brexit to have an impact on your ability to access finance, particularly from the European investment banks?
In terms of our ability to access finance generally, no, I wouldn't anticipate a major impact. We do have a very wide variety of sources, predominantly, and really the sort of underpinning pillar to the local government finance framework is access to on-lending from government through this the entity as was the Public Works Loans Board, now part of the DMO. And that there are no proposals to change that as a result of the Brexit process. We have access to the capital markets as a whole. I think, from a personal perspective, I don't discriminate between the credit quality of different local authorities. Investors in the market do, and we're happy to be on the sort of favoured side of that. London is seen as a tremendous investment case by the majority of our bond investors. So we don't envisage that would be materially altered by a change in terms of relationship with the EU. A very important point, source of finance within the group, perhaps less affecting colleagues at TfL, but certainly within the rest of us, is our collective pooled cash balances. So one of the things that is important in local government is the concept of internal borrowing. So rather than going out to borrow money externally to fund a project, or to finance a project more accurately, you might want to use some of the cash that's already sitting there. So borrowing is certainly very cheap at the moment, but investment returns are far lower. So borrowing incurs a cost of carry when you undertake it. So we can make that saving and also reduce our cash balances, which reduces the risk of losing it. So that you got a double benefit of cost and credit risk reduction. There are some risks to the approach, but again, we view that as being a significant opportunity over the coming years. So that totally unaffected by this process. So really, the only sorry.
I was just going to say, what are the risks to that approach?
Well, the risks are that the reason the cash is there is it's either capital resources, receipts or grants received in advance of need, or strategic reserves, a certain amount of working capital too. Now, the reserves are there because you're putting reserves aside, and you, by the kind of definition, you don't always know when they're going to be called. Now, the risk would be if you took an extreme internal borrowing position and essentially had a minimal cash balance. At the time you need to spend your reserves, you'll have to replenish that cash by borrowing. Now, if interest rates have turned against you at that time, that can be a pretty severe problem. And it's almost a sort of double whammy because by definition of having to call on your reserves, you're under financial stress. So the last thing you want is a massively increased interest bill. So that needs careful consideration. The other more subtle risk, which is sometimes neglected in the sector, is that saving can become really quite large. And unless you're careful to identify it and identify its place in the budget, you can end up subsidising your revenue budget as a result of your debt management choices. And again, if you have to reverse the debt management position, if you've been relying on that saving to deliver services, you'll have to cut those in consequence.
Simon, your thoughts on this?
So, European Investment Bank have been an incredibly important source of funding for us over the years. We have credit lines with them worth over £3.5 billion, of which we've drawn £2.5 billion, and they've also been a lender into the majority of PFIs or rolling stock leases over time. So very, very important. However, because of the access that we and the rest of the functional bodies have to the Public Works Loan Board, or the DMO as it is now, so directly to UK government borrowing that is on lent to the functional bodies, there is no liquidity risk from not being able to get money from the European Investment Bank, and there is a cap on the maximum penalty, if you like, from potentially borrowing from more expensive sources, because we would only borrow from sources to the extent to which they're cheaper than the Public Works Loans Board itself. So clearly we would hope that there is a way in which London and infrastructure projects more generally can continue to work with the European Investment Bank going forward, but there's a lot of water to flow under the bridge before we can get to that position.
There are people outside the European Union that do have access to the EIB, aren't there?
There are, yes. So they do have, they do lend to a number of other jurisdictions, and they lend in line with their mandated policies, such as air quality is one of them, mass public transport is another. So you would fit into those buckets, although we should expect that if we are no longer a member and no longer a shareholder in the European Investment Bank, that the stock of lending you would expect to decrease. We have, as the GLA themselves had, sought to make sure we have access to as many sources as we possibly can. So we have over £3.5 billion of borrowing from the capital markets directly. That has again been cheaper for us over time than borrowing from other government sources, and therefore by having that direct relationship we know that we can access the capital markets in our own right. We've also started to develop relationships with non-EU lenders such as Export Development Canada, and we now have over £750 million of financing from Export Development Canada for rolling stock and signalling, and that's a really important thing that the GLA family should do, to look beyond the EU to where
How
else.
recently did you set that up?
So we did the 500 million loan 2 years ago.
2 years ago, and
And
the loan just now.
We
in
signed
May.
a £250 million facility in April.
Okay, so the first part of that was pre-Brexit,
Yeah.
and the second part was
Post.
post.
Yeah.
Was that, why did you do that? I mean, because pre-Brexit, no one saw Brexit coming, did they? Let's be honest. It's not the only thing that hasn't been seen coming recently. But so, what was your thinking in terms? I understand entirely what your thinking would be now, but what was?
Well, so even pre-Brexit, not that we could see Brexit happening, but in terms of good debt management, you want to access the widest possible sources of borrowing. Just because anything, we've had both the global financial crisis, but we had a European sovereign debt crisis in 2011, 2012, where, for example, European investment bank pricing was significantly more expensive than other forms of borrowing. So they haven't always been the cheapest.
So it was just risk spreading.
It was risk spreading.
basically. Okay, sorry.
No, that's fine. What assumptions have you made on interest rates when you've been making your finance forecasts? All three of you, please.
I can start. For us, it depends on the project, what approach we would take, and in particular how long the period from now is that we're likely to be taking out borrowing over. And it also depends to a certain extent on the revenue stream. So obviously, the riskier the revenue stream, the more resources we'll put into the risk analysis of the original decision. So we typically assume a kind of planning assumption, which will be based on the rate now, and what the market is implying will be the rate at the relevant point in the future, and then we'll stress test that with a number of simulations based on historical experience to look at the possible range of variation and what that would mean to the affordability of the project.
Exactly the same. So we follow a very similar approach to Luke, and we look at the individual projects and the collective life cycle of our debts. We look at current rates and the market derived forward rates, and then, as Luke said, we all model the risks of increases in interest rates and compare them to long-term average interest rates in the UK, which are clearly substantially higher than they are now, and therefore adopt an assumption for any long-term borrowing or projects that would withstand significant interest rate increases.
Probably a bit simpler in that we focus on loans from the PWRB, and we use Capita and the advice we can get through the Group Investment Syndicate on the forecast of where their loans will be. And we, as I said before, we go for fixed rate loans, so we look at the loans as for the life of the asset, and they would vary, but that's how we base our forward projection.
So in your case then, interest rate variation will make no difference at all because you've already planned
For
it.
existing loans, no.
Yeah, okay. What impact would a change in interest rates have on financing costs for your existing loans?
So
Simon.
I'll go first.
Yeah.
Sue's obviously said she's
Yeah,
exactly.
So I'll start, Simon and Luke, please. Yeah,
So
indeed.
almost all of our existing stock of £10 billion of debt is fixed. So
Yeah.
on total, I think about 97% is fixed.
Okay.
So very little. And similarly, the facilities we've put in place that we've yet to draw down on from the European Investment Bank and Export Development Canada mean that we've actually forward locked the drawdown tranches for this year. So we are about 75 to 80% fixed on loans that will actually draw down later in this financial year. And so overall across our portfolio, again, we're in the high, we are predominantly fixed rate.
As you'll probably hope, given the level that interest spending is as a total of our budget, our interest rate sensitivity is very, very low. Predominantly fixed rate loans. The relationship, of course, between inflation and interest rates is not automatic, but to the extent that higher interest rates corresponded with higher inflation, yes, the interest on our linked bonds would increase, but then so would our income. So effectively very, very low. And like our colleagues in TfL, we're very keen to hedge future interest rate risk wherever possible. So for the Northern Line extension, for instance, the subsequent borrowing that we're expecting over the next 2 to 3 years is all arranged with forward contracts, so we know exactly what it will cost.
Will you need to refinance any of your borrowings the next 4 years, and what impact would a change in interest rates have?
For the GLA, we don't anticipate any refinancing. In fact, our problem is rather the reverse, in that the changes in funding, particularly in relation to housing, that have come about as a result of devolution of responsibilities, mean that the GLA is perhaps in a slightly stronger cash position than we were when I first started working on designing the debt portfolio for the Crossrail. So really we're looking for opportunities potentially to reduce external borrowings before they mature, rather than have to refinance.
Do you have any situation?
So we do have debt that is maturing over the 5 years, but we've built it into our forward plan and have arranged a large number of facilities, as we just mentioned, that we've already forward locked the majority of the drawdown. So we on top of that, TfL has the power to directly hedge interest rate exposures, and we monitor and discuss that with the TfL board at least quarterly. And as I said, for this year we are 75% fixed for this year's incremental borrowing, and we're discussing whether or not it's appropriate to do any more for future years at the moment.
Last question is about credit rating. How might a change to your credit rating affect your borrowing plans?
It might well change the mix that we decide on, although there are many other factors that can affect that too, because typically we would expect if the change in credit rating was material, and let's say we were downgraded by a couple of notches, the expectation would be that costs would be higher for borrowing from private sources. The cost of the PWRB would be unchanged. But I think it is important to distinguish between the reasons for the downgrade. If it's as a result of the UK being downgraded, we all move in lockstep.
What are the chances generally for public sector to be downgraded in the next, let's say, 4 years?
I couldn't possibly comment on the UK's probability of downgrade. There are many factors in play at the moment which make that difficult to tell.
Mid-sentence, if the UK is downgraded and you're about to talk about the Public Loans Work Board, and then I think you're about to say something quite interesting. Would you like to complete that thought?
So if the UK is downgraded, then potentially UK borrowing costs go up slightly, and so our PWRB rates will go up in tandem. But I think our spread relative to government borrowing would be reasonably unchanged. If we are downgraded relative to government, so if the UK stays where it is and people think that we're not doing a very good risk management job, and we get moved down notches, then that would likely have a severe impact on our ability to access other sources.
So in exactly the same way, it's, as Luke's just said, the absolute cost is effectively determined by the absolute cost of borrowing from government. So government's own borrowing cost and the spread from the Public Works Loans Board, and then any changes in our rating, whether it's the government themselves becoming downgraded and all government-related bodies having a knock-on effect on their credit rating, or the sense that a particular authority is not managing its finances as well as it has done previously, leading to a downgrade of an authority on its own, would impact upon the cost of borrowing from sources other than government.
Martin, do you want to add anything to what you heard?
Well, in terms of your question, the likelihood of a credit rating downgrade, that's got to be quite possible or quite high, because the credit rating agencies say so. They've got all the ratings on negative outlook, which means that they think it's quite possible that they would downgrade. So that's sort of quite a possibility. Whether it actually means anything, obviously we were already downgraded as a country
Yes.
in the last few years, and interest rates are actually now lower than they were before. That downgrade is a different matter. I think it comes back to some of the things about what might happen with Brexit and so on.
Yeah.
The biggest issue for a national position, which then feeds through to the availability of loans to local authorities, is the refinancing programme that the government's got. It's got about £700 billion to refinance over the next 5 years, and that's quite a big amount of money. And of course, a stable environment is helpful to that. And if things are not stable, sorry, I realised I made a mistake. I should have been more careful with my language there. But,
that is a very important point, that the supply and demand factors are much more important than ratings, which are obviously part of a relative picture relative to the rest of the world and other perceptions of risks and benefits implicit in the UK economy.
Yeah, but generally the point, that the main effect is, I mean, it's unlikely that that there's a real conceivable situation where the UK would not be a good place to lend money. It's the price at which lenders would be willing to want to ask for that money. Is the issue.
Downgrading of credit rating would not mean that people wouldn't lend us money. It means
It's
they
just
charge more for it.
They
Cost
might
of borrowing.
ask for more for it, because it's not just about the credit rating. But that would then feed through into the overall cost of debt. But the good news is the UK, because it's been refinancing quite a lot of debt over the last 5 years, it has refinanced 800 million over the last 5 years, that means that it's been able to lock in quite a lot of low rates. So generally, that's going to provide a drag on the rates going up too quickly in terms of the overall rate that, the combined rate on the debt.
Okay.
That's it, Chair.
Thank you. Well, that's a very hopeful and optimistic
Indeed.
point to finish on. We've come to an end. Can I thank all of our guests for giving up their time today and for the answers, and can I recommend that we note the answers given?
Indeed.
Thank you very much.
Noted, Chair.
We've done most of our business because we did it at the beginning. Item 12 is any other business that I consider urgent. There isn't any. The date of the next meeting will be Wednesday the 18th of October in Committee Room 5. And with that, I declare the meeting closed. Thank you very much. Thanks for doing that. Nevin?
Cheers.
Thanks very much.
See you tomorrow.
Yes, more fun.